In today's episode, we are going to be talking about how real estate syndications work. We're going to be talking about general partners, limited partners, how to raise money, the legal way to raise money, the non-legal way to do it as well too, what can get you in trouble. We're going to be talking about waterfall structures, just different structures for investors. To help us with that, we have Todd Robinson. He is a national known expert of real estate syndications, and he works or owns Robinson Franzman law firm. Welcome to the show, Todd. How are you?
I'm well, man. Thank you for having me.
So for our viewers that don't know who you are, who is Todd Robinson, and then how did you get involved in the wonderful world of real estate syndication?
Yeah. Thanks for that intro. So I'm a real estate investment and finance lawyer based out of Atlanta, Georgia. And I started my own law firm really with a laptop in my basement in 2018 and have grown it to a practice of over 25 staff. We've got about 13 lawyers with us. And we focus primarily on real estate and corporate matters. We do have a litigation group as well, but my main expertise is real estate syndications, real estate acquisitions, joint ventures, and really helping train real estate investors on how to grow and scale their real estate portfolio using other people's money. I speak nationally on real estate syndications at various multifamily conferences and other types of conferences as well. And I also have my own portfolio of assets of over $75 million. So I not only do this professionally, I raise capital for deals privately as well. So I bring that legal expertise, but also have the deal knowledge. You know, it's been said to me more than once, I just happen to be an entrepreneur that went to law school. And so I kind of view my law practice and my real estate business in that way.
So let's say somebody wanted to buy a property, like an apartment complex, without using any of their own money. What are the options that they have? Syndications, joint ventures, private lenders. What would you say those options are?
Yeah. So, I always say the number one rule of real estate investing is using other people's money. And other people's money can take many forms, right? Very many forms, like you just mentioned. I mean, it's even, it could be the seller in some instances, right? Creative financing techniques using seller's notes. The bank is obviously other people's money, right? That's not your money. You can use friends and family in a syndication structure, which we'll talk about in a little bit. You can use institutional partners in joint ventures, which is a separate sort of legal arrangement of how to purchase real estate. And you can even use strangers in certain circumstances. And that's another area of how to raise capital, using all these various methods so that you personally don't necessarily have to put in any dollars. Most of the time, and there's different schools of thought, but most of the time, lenders, though, will require whoever's guaranteeing the debt, whoever is signing on the dotted line and is the manager and in control, they'll usually require that you put in at least 10% of the required equity to buy a deal. Now, sometimes it has to come solely from the individual guarantor, and then sometimes it can be sort of the GP partners have to put that amount in. So you may not have to necessarily put it in yourself.
So let's jump into real estate syndications. What is a real estate syndication, and what's the difference between raising money via strangers versus family and friends?
Yeah, good question. So a real estate syndication is essentially a partnership between a sponsor who is the managing person who's responsible for acquiring the deal, executing the business plan, getting the loan, working with brokers, and making sure there's a successful exit, right? That's the sponsor. And limited partners, who are the money members of the company. They put in the money, and the sponsor puts in the sweat equity to execute the business plan. So it's a perfect marriage between two very important pieces of a partnership in order to execute a business plan and grow and scale the real estate portfolio. And the evolution of this really comes from a Supreme Court case, 1947. I think it's U.S. versus Howey, where the Supreme Court defined what an investment contract is. And I get questions all the time. well, is this a syndication, right? Or is this a joint venture? And so what we're dealing with is, what is the definition of a security under the Securities and Exchange Act of 1933, right? That's the regulation that came down, or law rather, federal law that came down after the crash and the Great Depression of the late 20s, early 30s, where people were running wild and taking advantage of investors. And so the Supreme Court defined an investment contract essentially as, if you're giving somebody money and you are expecting a rate of return without putting in any, without managing or contributing to the management of those efforts, and you're relying solely on someone else's efforts to make that money, right, then that is the definition of a security under the Securities and Exchange Act of 1933. And so the first question I always ask when clients come to me and they want to use other people's money and they want to raise capital for a deal is, I say, well, look, are these people that you're getting money from, are they expecting to be active in the company? Are they going to participate in management decisions? Do they have other roles within the company that give them some sort of responsibility? Or are they purely passive and they're just giving money to you and you're going to go out and buy a building and make them 10 or 20% return? So if the question is the former, then that is what we call a joint venture. And that is not subject to SEC regulations, right? That is all handled within an operating agreement where we clearly define the members, we clearly define the roles. You and I are going to go buy a building. I'll put in $100,000. You put in $100,000. We're going to manage it together. That's not a syndication. That's not a securities issue. The securities issue is, and even if it's one person, I get this question all the time. Well, it's just one LP, right? Well, that the SEC does not define whether it has to be. If it's one, it's okay, right? If you give me your money and I go out and buy a building and you say, hey, just mail me my checks every quarter and let me know when the property sells, that is going to be the definition of a security, and we need to comply with SEC regulations.
I love it. And then what's the difference between strangers and non-strangers?
Yeah,
How does that play a role?
Yeah, good question. So within the, it's actually called Regulation D of the Securities Act of 1933. There are two options. There's what's called 506B offerings, which is the citation to the act, to the regulation, and 506C offerings. Okay. At first, it was just 506B. But then the Jobs Act of 2012 introduced a different option, 506C, and that was really a result of the private equity community that came around and said, look, we want to leverage social media, we want to leverage online advertising, we want to be able to advertise these offerings, SEC, so please find a way to let us do that. And so the SEC came back and said, okay, we'll let you do that, but here's the rub. And I'll explain the difference. So a 506B offering is what we typically call the friends and family plan, right? That is where you can raise capital from 35 unaccredited investors, and I'll explain what that means, and an unlimited amount of accredited investors. All right. You are not allowed to advertise the offering, okay, in a 506B offering. So that's the biggest rub. You're not allowed to advertise the offering, and you must have a pre-existing substantive relationship with the investor, and you do not have to verify their accreditation as an accredited investor. You're allowed to rely on what's called self-certification. So the investor comes to you and says, well, in our documentation, in our subscription agreement, we have them fill out the investor questionnaire that says, yes, I qualify as an accredited investor. So what is an accredited investor? If you have a salary of $200,000 or more as an individual, or $300,000 or more as a joint couple, married couple, or your net worth exceeds $1 million, excluding your primary residence. So if you satisfy those requirements, then you're considered an accredited investor. So most syndicators and real estate investors that want to start raising capital, they start out with the 506B because they may not know a lot of accredited investors. And so that seems to be the easiest route to go. Now, what is a pre-existing substantive relationship? That's another thing that, the SEC doesn't give us the playbook because they want to keep their, enforcement jobs and they want to make sure They don't give us everything. So we kind of have to read the tea leaves a little bit. And generally speaking, it's someone that you knew prior to the deal going under contract. I always tell my clients, and that you just have a relationship with, right? It doesn't have to be, it doesn't have to be a strong relationship, right? But, the fact that you and I are talking right now about this, and, I'll probably get into your database and you'll get into my database, and we may email each other and text each other a couple times. You're now within my network, right? As an investor, right? Yeah. And same with me being in your network, as long as we have no active deals that we want to invest in. In a 506C, you can only raise capital from accredited investors, right? So you're not allowed to raise capital from unaccredited investors, but the rub that the SEC came up with in the Jobs Act of 2012 is that you're allowed to advertise in a 506C offering. And that was the private equity community was very happy with that, because they're like, okay, fine. You may be limiting the scope of investors, but because you're limiting it only to accredited, but now we can go advertise on Instagram and Facebook and LinkedIn, and you can do webinars, and you can invite people over, to watch a presentation, things like that.
Now, let me ask you this. Like, what if I wanted to buy a deal, but I didn't want somebody else to have any ownership rights in the deal? Meaning like let's say I had a deal for $1 million and I needed, and I have a pre-existing relationship with them. Could I go to somebody and just offer them a month, like a coupon, like basically like a bond, basically?
Yeah. So let me explain how syndications work. So we have what's called a GP-LP split. The GP is typically the sponsor. The LPs are the limited partners that put in the cash. Now, when the LPs come in and they provide cash, they get a share of the equity, and they typically receive what we call a preferred return, which is kind of like what you're talking about. It's like a quarterly payment based on their capital that they've invested. So if someone invested $100,000 with you and you're offering them an 8% preferred return, they will get $2,000 a quarter, right? When you sell that property, and you make this arrangement really to entice investors, right? When you sell that property, you offer them a share of the profits, right? It's typically, I would say, the very vanilla deal is investors get 70% of the profits and the GP gets 30% of the profits, right? Because the investors are putting in the majority of the cash. That's a typical vanilla deal: 8% pref, 70-30 split. If you sell the property, you've got $1 million of profit. Well, $700,000 is going to the investors, and $300,000 is going to go to the GP or the sponsor.
Got it.
So in that scenario, it's not debt, right? And there's a big distinction of you don't want to. And I've got a lot of clients that I have to kind of restructure how they do deals because they're not doing them correctly. You don't want to sign a bunch of promissory notes with your investors, right? Because if you do that incurs an obligation to repay the money, right? Now, under an operating agreement, it's an equity investment. It's not a debt investment, right? So there's a big difference between those, the legal ramifications of a debt investment versus an equity investment. Of course, you still need to repay it under an equity scenario, but if you don't, there's no legal, you will likely get sued by your investors, right, for breaching fiduciary duties and whatnot, but there's no, a promissory note has a legal obligation to repay, and if you don't, you're in default, for instance.
Got it. So basically, a scenario that I just described is almost like a debt obligation, which in that case, it doesn't give them any ownership, but there's also negatives associated with that as well, too, if something were to go not the right way, basically.
Right. Correct. Yeah. And so with limited partners that are members of the company, right, they're limited members. They don't have any ownership rights. They don't have any, voting rights. They have no control. The control is all funneled to the management entity, which is the sponsor. But if you wanted to offer, an investor, hey, I'm going to give you an 8% per year. And when I sell the property, you're not going to get any profits. You'll get your capital back, and you'll get any accrued preferred return that I haven't paid you yet, but you're not going to get any upside. You don't get any share of the profits. 100% of the profits are going to go to the GP. You can certainly structure a deal that way, but I think you'd be hard pressed to find some investors that would go along.
That would want to do it that way, basically. Right. Got it. So essentially, what are the different structures like that you can offer somebody? So I've heard the term general, not like waterfall structure,
Hmm.
um, but I don't really know what that means. Obviously, preferred return, like what does that mean? So
Yeah.
like, what are
So
all these different terminologies?
yeah, good question. So preferred return, like we just talked about, this 8% preferred return. And when it says preferred, what that means is it gets paid before you as the GP get any money, right? So in the order of events from a capital event is going to be a sale or a refinance, right? In operating agreements, you have, okay, this happens, this happens, this happens, this happens. So it's, we pay off the senior debt, we put some reserves in the company to pay taxes and any lingering expenses, right? We repay member loans. And then after all those company expenses are taken care of, you've got kind of the pure profit left. Well, after that, you pay any preferred return that has accrued. When I say accrued, that happens when you have a value add project that maybe you haven't been able to
Pay
pay out any.
distributions.
Right, you haven't been able to make any distributions because you're still stabilizing the property. Right? Once it's stabilized, you make all those payments kind of on the back end. So it's preferred in a sense that it goes to the LPs prior to the GP receiving any cash. That's a big
Got it.
selling point for investors, right?
It doesn't mean that you have to pay them monthly. It just means that they get paid before
Exactly.
anybody really takes a profit, basically.
Right. It's preferred in the order of payments, not that's it. It's just in the order of payments. Now, typical documents will say it's paid quarterly. Obviously investors really like monthly payments, but typical documents it's paid quarterly. And it's also paid pursuant to the manager's discretion. So if you're managing a deal and you need cash flow and you're not able to pay out any distributions, then that's fine. There's no harm, no foul.
Got it. What's the alternative to a preferred return, and what are the pros and cons?
So, well, let's back up let me explain what waterfall is too. So a waterfall basically means you've got this concept of what's called an internal rate of return. I don't know if you probably heard that term.
I've heard the
IRR.
term. I don't know what it means, though.
Yeah. So IRR is just another investment mechanism that investors use to analyze the returns that they receive. And it's a little funky because it's not like a straight accounting mechanism. It's not like a cash on cash return. It's not an average annual return because the IRR calculation does have a velocity component to it. So if you have a 5-year business plan for a deal, but let's say you just knock it out of the park and you return all your cash back in year 3, you return all the capital and you sell the property and you hit all your numbers. That's going to have a higher IRR than giving it back in year 5. And I don't, that's a bit over my head as far as how the actual math works, right? I mean, we have AI to calculate that now. But it's a mechanism of, like I said, kind of, it looks at the overall health kind of the deal based on how much capital was invested, how much preferred return someone has received over the life of the deal, and then what their payout is at the end. And then there's a math calculation that does the IRR. So a waterfall hurdle is basically a stair step of returns. So remember we talked earlier about an 8% preferred return, and we talked about a 70-30 split, right? 70 to the LPs. Well, let's say you're the sponsor and you just crush it on this deal. Like you start pushing rents day one, you finish your CapEx ahead of schedule and below budget, and the deal's just become a cash cow now. And you're starting to really just pay investors back quickly, pay them back their capital, return of capital, and the return on capital. Then your IRR is going to go up, right, for the investors. And so a waterfall is the initial IRR is 8% in our example. Let's say by making those efforts, the investor's IRR now goes to 12%, right? Well, now the payout on the back end adjusts from 70-30 to 60-40, right? So you as the GP, you are incentivized to do well under a waterfall structure because that means you're going to get a larger share of the profit. Now, let's say the waterfall goes to 15%. it can go 60-40. Let's say it goes to 20%, it can go to 50-50 even.
So basically, the better you perform, the better in that structure, the more you can be. So it's basically almost like if you meet certain KPIs in a business, there's certain rewards for meeting those indicators. Basically, it's almost like the same thing.
100%.
It's funny because I had never, I own my own properties, and I'm selling a property to a friend right now. And the way he described it to me was like, look, it's almost like anytime you're acquiring a property that is not performing to the best of its ability, you're buying like a business that you have to turn it around and basically make it into a producing property, which it's basically you're executing a business plan, which I'm hearing the same thing here, that you're basically executing a business plan. So what would you need in order to offer something like this out to friends? So you would need to know, obviously, the purchase price. You would need to know how much it brings in rents, what the market rents for the building are. You would need to obviously know what the game plan is for CapEx. What are the things that you would need in order to come up with some sort of offering to friends?
Yeah. Well, it's funny you say that. So this kind of happened tangentially or organically. I actually have a real estate mentorship program where I mentor real estate investors on how to grow and scale their real estate portfolio and how to really buy their first deal using other people's money and using syndication methods. And that includes, how to build lead magnet systems to raise capital, how to underwrite deals, how to find deals, how to work with brokers and lenders, and the whole bit. And what you're talking about is really the underwriting piece of it. And so, and to go back on your prior point, yes, you're buying real estate, but you are absolutely buying a business, right? You're buying income producing property, and your business is to make sure the property produces income and that you treat the property well and you execute your business plan. Now a business plan, when you're buying income producing property and you're trying to make a profit, really consists of, decreasing management inefficiencies, right? These are all what we call value add opportunities, right? Mm-hmm. Where can we add value? It's the same strategy Blackstone uses, right? One of the largest asset management companies in the world. Buy it, fix it, sell it. That's basically the business plan. Buy it, fix it, sell it. So you got to buy it right for the right price. Your fixing of it is the value add. A lot of times in multifamily, which I primarily focus on, the value add comes from decreasing management inefficiencies, upgrading units so that you can achieve a higher rent premium, and adding amenities and curb appeal and things like that. A lot of the same things you see in residential real estate apply to commercial real estate, but the value really comes from adding to the tenant units or increasing the value based on increasing the improvements. And so from an underwriting perspective, there's a whole financial model that we use in our mentorship program and I use personally where we underwrite all of this. And so that includes analyzing the rent roll, looking at the purchase price, looking at the cap rate, looking at what your assumptions are, right? You gotta include like a vacancy assumption, right? Because you're not going to collect 100% of your rent typically, right? What is your loan? What is your interest rate? How quickly can you get the rents to current market rate, right? So all of that whole process is called underwriting. And once you become really good at underwriting, you can analyze a deal in 10 or 15 minutes, right? You can just put your numbers in and it'll spit out some return metrics. And if you've already kind of nurtured your leads with your investors and your investors want a 15 to 20% IRR return, and this is spitting out a 12%, then it's not a good deal and you move on to the next one.
Got it. Okay. And then, so I've actually invested in a couple syndications. I did one with a self-storage facility. I'm involved in a mastermind. I'm not sure if you've heard of it. It's called Collective Genius.
Oh, I haven't heard of that one, no.
So there's about 250 of, maybe even 400 now, the top investors around the country. And basically they basically all do different things. But we did one. But to be honest, like, I didn't know what to look for. It was almost just based like, hey, you've got this deal. I need a tax write-off.
Yeah.
Could I get some of the depreciation on the deal as a limited partner? But assuming, like, let's say on the opposite end, I'm going to invest in a deal, what type of documents should I be reviewing? And then I'm guessing that all has to do with the underwriting process, like knowing how to underwrite to see if their assumptions are realistic as well, too.
Right.
And then what are the documents that I would be reviewing, in other words?
If you are a limited partner and you want to
Yeah.
invest in someone else's deal, yeah. So I have a whole course on this exact issue because it's very important as a limited partner, right?
Yeah.
You got to be really, the first thing you got to do is you got to vet the sponsor.
Yeah.
So you got to look at their track record. What other deals have they done? What are their average returns that they've made? Do they have any legal troubles? Have they ever been sued on a financial obligation? Right? Have they ever been sued on
How would you
guarantee?
find these things out, though?
Well, you can search. I mean, you can do background searches. You can definitely do background searches and just ask them outright as well. But I would be if I were investing as a limited partner deal, you would first look at the offering memorandum that the sponsor is sending you. That document would contain information about the property, information about the sponsors, the location, the return metrics, and kind of what they're projecting as returns, right? Then I would probably, someone like me, I'd probably underwrite the deal myself. I'd ask for what's called the T12. The T12 is basically a profit and loss statement. Trailing 12, right? A profit and loss statement for the past 12 months. And then you look at the rent roll and you get some information there. Now, a lot of times if it's purely passive investments, these guys are not going to provide that information. But if you're a little bit more sophisticated and you do real estate, you can ask for that for sure. But then really kind of understanding the financing is going to be really important. Understanding the risk, right? Is it a floating rate debt product or is it a fixed product? What is the location? Where is the location? Are you comfortable with the location, right? Really heavy value add deals, I think, are better, higher risk, higher reward usually.
Yeah.
Those are deals where, say it's a 100-unit apartment complex and half the units are burned down. That happens quite a bit. That provides a lot of value to the next guy that can come in and put all those units online. But typically that's a riskier situation because there's a lot of just extra economic risk and construction risk when it comes to those kinds of deals. So really kind of understanding as a limited partner, what is your risk tolerance for deals like that?
Got it. Now, what is the difference between like a fund and just like a one-off type of syndication?
Yeah.
And is that a fund considered a syndication as well too?
So the terms are kind of interchangeable. When we say syndication, it is a asset specific offering, private offering, right? And it's important to note these are considered private offerings from the SEC. From the SEC's perspective, it's a private offering of securities, right? Mm-hmm. Now, that's very different than a public offering, right? We've heard about Tesla and Uber and all these companies that have gone public, right? When they go public, they get scrutinized by the SEC on the front end. They get they get put through the ringer, and the SEC says, okay, we approve the offering. You can issue these shares on the public market. In a private offering, that's not the case. We are offering this privately to our own network pursuant to what we talked about earlier, whether it's a 506B or 506C. A syndication is a deal-specific offering, private offering. A fund is an offering that can invest in multiple deals, basically.
Got it. But is it still considered a syndication?
It is, yeah.
Okay.
Yeah. And then there's another distinction between what we call like a blind pool fund, right? And that is where that's how traditional private equity firms are created, where you invest money and they can go invest it in this private equity fund. They can go invest it in whatever they deem appropriate. But in the real estate world, we don't have blind funds. We have, either asset specific funds, or you can invest in a fund that says, I'm going to go buy, multifamily properties in the Southeast with this buy box, right?
Got it. Where would you state, like, let's say somebody is raising money from family, but they're not doing a syndication and they're considered limited partners. What kind of trouble could they get into if they did that? And then how would you fix something like that?
Yeah, well, it goes back to what we talked about earlier: is what is their level of activity, right? If it's even if it's a family member, I mean, the SEC does not make a distinction between, well, if it's a family member, it's okay. You can take their money and invest it and pay them a return, and they don't have to do anything actively in the company. And it's not a syndication. They don't make that distinction. They don't have distinctions between one and two members, LP members, and family members. So what you would do in that situation is you just would want to draft the operating agreement so that they're joint venture partners, right? You'd want to have the family member have an active role in the company. And it can even be, that the family member participates in major decisions of the company, right? So if you need to sell the property, you want to take on a greater debt, or you want to admit a member to the company, or you want to, go spend $100,000 on a contract for some reason. Those major decisions, you just have to document that the other person agreed to it and put it in the corporate minutes. Then they've discharged their duty as far as participating in the company goes.
Yeah. What happens if the property goes south in a syndication? Because I saw somewhere on social media, somebody had these large apartment complexes, and I'm imagining that when the rates went up, it became a little bit more common as well too for certain people.
Yeah, that's what we're dealing with right now. I mean, we do quite a bit of foreclosure work, quite a bit of workout work and receivership work. So if it goes south, then the lender steps in and either forecloses on the property or issues a receiver and takes over management. And the LP equities are really, the LP investors rather, are really wiped out. There could be a total loss of capital if that happened. And if that happens, then the sponsor is usually in some legal trouble, right? They are likely getting sued by the lender. They could also be sued by the investors,
by the limited partners.
And then that. But again, like we talked about earlier, you're not suing under a promissory note saying you owe me this money. The investors have to make a different claim about breaches of fiduciary duties and management responsibilities and things like that. This brings up a good point. Part of the offering documents that we provide to our clients and my students include what's called a private placement memorandum, PPM. And what this document is essentially a large 50, 60 page disclosure document. I like to call it PPM CYA, cover your ass, because this document basically says, hey, investor, a lot of things can go wrong here. Right, there are conflicts of interest. There's construction risk. There's economic risk. We may not be able to execute our business plan if this happens. There's foreclosure risk. Right, advising the investors that these risks are possible and they're out there, and the investor chose to still invest. That's usually the biggest defense. If there was some sort of case from an investor, it would be go look at the PPM and look at these risks and see what was disclosed. And if you decided to invest anyway, despite these risks, then you would call it an assumption of the risk, right? That's the defense.
Is the liability higher with the 506B versus the 506C, considering that some of the investors are potentially non-accredited?
Yeah, that's a good point. I would say, I don't know. I don't think the liability would be higher, that you could quantify that. But I think there is something there, that the fact that the 506B includes unaccredited investors, that the sponsor does need to take a little bit extra care and precaution in a 506B. In a 506C, the assumption is everyone's sophisticated, everyone's accredited. You still sometimes some other, I don't recommend this, but some other securities attorneys don't even do PPMs in a 506C, right? In a 506B, it's absolutely, I mean, the SEC does not require a PPM to be provided.
Is the purpose of the PPM to cover your CYA? It's basically to cover your ass. So why, if the purpose is to cover your ass, why wouldn't they do it?
Because I think in a 506C, the assumption is everyone knows the risks because they're
accredited, basically.
They're accredited. Yeah, exactly. But I would never do that. I would do it under either scenario.
Yeah, because even accredited investors can come back and say, hey, look, something wasn't handled properly or managed properly. Yep. How does the sponsor or the general partners get paid outside of the potential upside of the deal?
Yeah, very good question. And this is how a lot of syndicators and real estate investors earn their living, right? I mean, you obviously get paid on the back end when the property sells, but you also get paid on the front end. And so sponsors will charge an acquisition fee. That acquisition fee is typically 2 to 3% of the purchase price. Acquisition fee is typically paid at closing, and so as long as you've raised enough capital for it, then the money will be there. You can go ahead and pay your acquisition fee at closing. There is also an asset management fee that the sponsors get. The asset management fee is not a lot. It's usually, you kind of tack it on to the property management. It's like 1%, maybe 2% of the gross rents. And so it could be a couple $100 a month, but that also just compensates the sponsor for the ongoing management of the investors. And then obviously there's tax benefits, the depreciation, if you want to consider that a form of getting paid. And then on the back end, when you sell the property or you refinance and you hit that promote and you're able to achieve a portion of the upside, that's the third way that they typically get paid.
Got it. Okay, cool. What else? What else are we missing as it relates to?
Yeah, we've covered quite a bit. In syndications, it's a great way to scale. There is a ceiling, I think, if you are just using your own capital, because if you can put in 10% on a deal and raise 90% from somewhere else, then you can deploy any additional capital you have to other deals. So every large real estate investment company really kind of starts and abides by this method. The other piece I would harp on is really how do you raise capital from investors, right? That's a question I teach in my mentorship program, and then get asked all the time. In this day and age, obviously you have your friends and family, right? And you can go to your uncles and your aunts and people personally, and you can ask them for to invest with you. But then how do you access other accredited investors that you don't know, right? Because there's a ton out there. All right, how do you just promote your deal? I think raising capital from that perspective is a skill set in and of itself. Uh-huh. In this day and age with social media and the internet, it really requires nurturing through email marketing, through text messaging, and building what we call a lead magnet system, and having the patience to build, really a content machine that lets the broader public know what you're doing, right? If no one knows what you're up to, they're certainly not going to go and invest with you. So you have to really kind of retrain the market on your offerings.
What I was going to ask you is, I know you mentioned that usually it's a 8% preferred return and maybe like a 70-30 and then the waterfall structure. What are some of the different structures that you've seen that are outside of that norm? And in what situations have you seen that?
Yeah, good question. So I'd say the most generous structure for GPs would be, a 50-50 split of the profit is obviously out of the gate. That's a very generous structure. But anyone who's doing this for the first time or is getting into this and you're talking to investors, any savvy investor is going to say, like, that's too much. I'm not going to let you get that much profit. But if you've got the track record to back it up, you can say, look, it's a 50-50 split. It's an 8% pref and a 50-50 split. But I think it takes time to build that. Some other structures is that you could cap a return at, say, 20 to 25%, right? So if it's a cash cow and the returns are so good that they get all the way up to 25% IRR, then anything above that just goes to the GP because they've hit a really good return.
Yeah.
Another structure that I get asked about a lot is, how do I finance my investors out so that I own the property free and clear? And you can certainly do that. You just have to, we have to build it into the operating agreement, and you got to make sure the investors agree to it, obviously. But it would be a situation where, upon receiving X amount of return, the members shall, receive their entire capital back plus this amount to achieve that return. And upon that happening, you redeem their shares, right? So the GP would redeem their shares, and the Class A member note ceases to be a member of the company.
Got it. So it's basically after they hit a certain metric.
Yeah. And that's a good option for a lot of high W-2 earners, busy professionals that want to recycle their capital pretty quickly.
Mm-hmm.
Right. And so we've offered that. And I'm an active investor. Like we're purchasing a 60-unit deal here in Georgia, Milledgeville, Georgia. I'm also purchasing a senior, luxury senior living deal here in Atlanta as well. Both of these are kind of going simultaneously, but we have that option as well, that if you hit a return, then you're out of the deal at that point.
Got it. It's funny because as it relates to OPM, I had somebody tell me that you're not really an investor or real estate investor until you use other people's money. And when he said that to me, I was like I've been buying real estate. I did it very traditionally by saving 20, 25% down or doing creative deals. But it kind of hit me and I was like, oh my God. I've never I've limited the growth by just having to save up the capital myself. Yep. And I probably have let go of a lot of opportunities that were available had I had the right information at that time, basically.
Yeah. I don't know if I quite agree with that. I mean, obviously you're a real estate investor. You're just using your own money instead of other people's money.
Yeah.
Right. But most investors, I think, are raising capital from other people. And the interesting thing is, there's enough people out there that it's not that hard to raise capital once you have the mechanisms in place, right? And the first thing I do with students that join our program is we form their real estate company, right? We don't necessarily do it ourselves, but we help them create and develop their own identity, right? Their corporate identity, their brand, their holding company, that they can then use to go and promote all of their offerings and promote their deals. And so that's an important piece, because people need to know what you're up to. I have one of my students, she had this brilliant idea, and she hosted this dinner at her house. And it was like, she branded the dinner. It was called Influencers and Connections or something. Mm-hmm. And it was basically just a big dinner with all of her rich friends that she use it as kind of like a launch party to launch her real estate investment company.
Nice.
And it was a really good, I've used that technique with other people, but it's a really good way to kind of kick it off.
Got it. If somebody, so can you share with us just a couple of tips if somebody wanted to raise money aside from that example that you just gave us?
Sure. Yeah. So obviously friends and family, number one, but if you're looking at building the lead magnet, which we call what is a lead magnet? A lead magnet is an offering, it could be a document, it could be a webinar, right? It could be an ebook, it could be, something that entices your investor to opt in first to receive information from you, right? You got that opt in, so they're now a part of your network, and you reach out to them, you develop that pre-existing substantive relationship. But you constantly, next week I'm speaking on a group out of Texas called Momentum Capital, I think is what it's called. And they're having me on to talk about 1031 exchanges and how to structure deals with 1031 exchanges, right? That is a lead magnet for them, because everyone that comes and joins that webinar, they're going to get their information, they're going to get their contact information, and then they're going to reach out to them, and then they're going to start receiving content from Momentum Capital on a weekly basis. about what they're doing, what kind of offerings they have, what kind of returns they've had in the past. And then once a deal comes around that they're ready to execute on, raising that capital is as easy as, let's send out an email to our existing database of investors that know us and let them know we have the deal ready.
For a 506c, does it have to be deal specific, or can it just be, hey, look, we buy properties from time to time and we take on partners?
Well, that's really the difference between a fund and a syndication. I mean, it would need to be deal specific.
So all of these lead magnets, how would they work if it's not deal specific?
Yeah, so building the lead magnet, what I would recommend is that when you do have people opt in, and say you do a webinar, right, and you're just saying, this is my company, I buy real estate, these are our returns, this is what we're looking at, and you get 50 people to join. I would reach out to each one of them personally and talk to them, maybe get their number, put them in your database. That way they become a pre-existing substantive relationship for you so that you could use a 506B offering.
B basically at that point. Good.
Yeah.
Okay. Any books that you would recommend on this? And then let's say somebody wanted to get involved in your course. How would they go about doing that, and how would they get in touch with you as well too?
Yeah, man. So any books, I'd have to think about that. You know, everyone starts with like Rich Dad, Poor Dad. You know, that book has kicked off a lot of real estate investing careers. The Bigger Pockets podcast is obviously very good for learning real estate investing, learning real estate syndications. My yet to be drafted book, haven't written it yet, but and then as far as getting in touch, I mean, so obviously I represent clients in real estate syndications. So anyone who's looking for legal services can just reach out to the law firm, Robinson Franzman, or, you know, call me or email me there. And then the mentorship program, you know, our website is toddrobinsonesq.com. And there's, you can get some information there on the mentorship program. And you know, we would just reach out and schedule a call, an introductory call, because it's not, you know, I'm not trying to create this huge juggernaut of a mentorship program. It's really kind of a small batch community of people, and that's on purpose. Because I'm doing my own deals and I'm running my own law firm, and I don't have, you know, 8 hours a day to devote to it. But also, it really is one-on-one hand-holding. So, you know, we have weekly calls, one-on-one. We've got a group call on Tuesday evenings, and then it really is like, this is what you do next, right, to really grow and scale.
I love it. Good. Well, I want to say thank you so much for being on the show. This is a topic that I have a lot of interest in that I've never actually executed. So I appreciate your time. For our viewers here today, we had Todd Robinson. He talked about how to do a real estate syndication. We talked about general partners, limited partners, fees, sponsorships, all inclusive video. If you enjoyed this episode, make sure to hit that subscribe button. If you feel this episode will be helpful, make sure to hit that share button. Thanks again, Todd. I appreciate your time, and I look forward to connecting in the future.
Awesome. Same here, man. Appreciate your time.
Bye.